Okay, so now let's take a deeper dive into stock returns and how we want to model the risks and rewards of stock returns. So let's start with a very straightforward project. We're going to buy one share of the SPY ETF, hold it for 1 year and sell. And as we know, the SPY is an ETF that aims to replicate the returns of the S&P 500 stock index. And just to give you a little context, at 326, 2020, SPY is off by 30% from February 2020 peak. And in the Great Recession, the SPY and the S&P 500, of course, it lost about 50%. So it's quite possible this coronavirus problem that we're having in 2020 is worse than the Great Recession. And if that's true, the S&P 500 and the SPY will continue to decline at some point. Okay, so enough of the real world context. In general, how are we going to characterize the returns for this project in terms of reward and risk? So remember, for a project of this type, our return is just price at end of year minus price now divided by price now. So how could we figure this out? Well, here's a very common way to do this. We're going to characterize the returns of the SPY via these steps. And what I mean by characterize is characterize probabilistically. That's our whole goal here, is we want to do something similar to, something analogous to what we did with the cash flows of the bonds that we looked at before that were Bernoulli distributed. These are going to turn out to be normally distributed. So to start with our characterization of SPY returns, step number one is we want to look what's happened historically. So we're going to build a long list of historical annual returns. So I've got a partial list shown going back to 1992, but we would want to go back way beyond that, at least to 1980, maybe farther than that. So I have my closing price here of the SPY for each of these years, okay? And then from those closing prices, I can get the return using the equation we just saw on the prior page. So for example, the 2018 year return, which we have here at minus 2.43%, how did I compute that? Well, how did I have Excel compute that? More to the point, I said 267.4455. That's the price at the end of the year, minus 274.0989. That's the price at the beginning of the year, divided by 274.0989. And that's how, using these two numbers, I was able to get that return. And that same computation is true for every return computed here. Okay, so that's step number one. Step number two is, now that we have all these returns, let's do a probabilistic statistical analysis on this data. Okay, and so always good thing to do when you're analyzing a random variable and you have some historical data is to create a frequency distribution. So here's our frequency distribution graph here. Okay, and this pretty much should look kind of like a normally distributed set of data here, okay? And that's what typically is always assumed in a case like this for stock data. And why is it always assumed to be that way? Because the distribution graphs really do honestly typically look like this, okay? So this is our histograms, our frequency distributions typically do look normal for annual stock returns over time. So once we say that, we can go ahead and numerically compute our key statistics for the historical data. Okay, so I've gone ahead and done that for us, and I found our average return. X bar is, of course, for our sample data. Our average return was about 8%, and our standard deviation sample, once again, was about 25%. So that's step two. So we have a pretty good feel now statistically and probabilistically for what happened in the past. We can say the annual returns historically of the S&P 500 tend to look normally distributed, and they had an average annual return of 8%, a standard deviation of returns of about 25%. So our third step is to say, how can we carry this into the future? We're concerned with making an investment like this today and what's going to happen when we come out on the other side a year from now. So very, very important, okay, is to decide what we're going to do in the future. We have to start with a key foundational assumption, and that is that the future returns for the SPY and the S&P 500 are going to look like their historical returns. We can't really do much without making that assumption, and this may be a bogus assumption, and I'll talk about that more in a little bit. And once we make that assumption, okay, so once we make that assumption, then we can say, okay, well, if the historical returns look normally distributed, we can say the future returns will be normally distributed, and we can estimate them with our normal density function. Okay, so what we're going to do is we're going to morph this frequency distribution into, say, hey, let's model this as completely normally distributed using the normal density function, and let's morph our sample expected value into the expected value of the normal density function, so we'll call it mu, and the standard deviation from our sample S, let's morph that into the standard deviation of the normal density function, call that sigma. So the numbers are the same, and we've changed the symbols to make it clear that we're now working with the normal density function. So there are two implications of our model here, and one is that we're going to consider our reward measured by our expected value mu. So what do I mean by that? We say something like our best guess at next year's return is 8%, and we can also say on average over the long haul we expect SPY to return 8% annually. So that's how we think about our reward. And the second thing is we want to think about our risk. So our risk is going to be measured by probabilities based on the spread of our normal distribution of returns. And as we know, more spread is going to give us more risk. And I've tried to illustrate that for us here over on this graph where I have three different types of investments, okay? So these are probability distributions, okay? And down here on the x-axis, I have my return percent. So if we look at something like investment B, so this could be the SPY annual returns, we have something that is very, very spread out here. So there is something like maybe a 5% probability that we're going to have a minus 30% return or worse, okay? And there is something like a 50% probability that we're going to have a 20% return or better, things like that, okay? And if we look at the other hand on investment A, which might be something like corporate bonds, we find that we have much less spread of returns. We could still get negative returns. Companies could go bankrupt, right? And we're not going to get everything back, but because we have those great contracts, we will get something. But we have much less spread, so that's much, much less risk here. And if we look at our third investment here, US Treasury notes, we see there's almost no spread, okay? And the reason for that is that as we know, everybody in the world considers the Treasury the safest investment out there, so the probability of doing better, doing worse is very, 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 very low. Okay, the other thing that's important to notice about this is as we take on more risk here, as denoted by the wider spread, we have a higher reward, a higher expected value. Okay, so the expected value of the SPY is higher than the expected value of the bonds, and that's higher than the expected value of the treasuries. So this is our classic risk-reward trade-off. The more risk we take, the more spread we have in our returns, the higher the probability that we could have a very bad outcome here, the higher the reward on average measured by expected value. And if we're very risk averse, if we don't like risk at all, then we would want to be in something like treasuries, but we're going to pay for that with the lowest expected value of just about anything we could do. Okay, so we're going to be measuring our risk one way or another by looking at the spread of our normal distribution of returns. And we'll use a graph something like this to help us do that, okay? We're gonna want to compute probabilities of our normally distributed returns, and let's see how this is going to work for our SPY example, okay? So we have, with our SPY example, we have expected value of 8%, standard deviation of 25%, and this is the normal density function graph here. And what I've got on the x-axis is measured in standard deviations away from our expected value mu, and the percents here are probabilities. So 19.1%, for example, means we have a 19.1% probability of our return being between mu, which is right here in the middle, and mu plus what? 0.5 times sigma, okay? And separately, there's also a 19.1% probability of our return being between mu and mu minus 1/2 sigma, okay? So we have two of these 19.1%. One is 19.1% probability will be between 8% and half of 25% plus 8%, and same thing, corollary on the downside. All right, so let's see if we can actually compute some probabilities and associated ranges using the graph back over here. Okay, so let's compute the probability that the annual SPY return will be within, okay, mu minus 1 standard deviation to mu plus 1 standard deviation. Okay, I'm actually going to start with the range for us, and that's going to help me look back at the graph and get the probabilities here. So what we've got here is 8%. Our range is going to be 8% minus 25% to 8% plus 25%. Okay, and that gives us, if you do the arithmetic on that, that gives us minus 17% to our 8 plus 25, I think is 33% in most circles. Okay, so that's the range that we're going to be in. And now let's go back to the graph and get the probability. Okay, so here's my mu, okay, which for us is our mu equals 8%, right in the middle there, and also sigma equals 25% here. We can put that over here just so we remember it. Okay, so I just want to add up my probabilities from minus 1 standard deviation down from mu to 1 standard deviation above mu. So I add 15 and 15, that's 30, and I add to that 2 times 19.1, and you can check this out along with me, that is going to be 68.2, 2 times 15% plus 19.1%, and that's equal to 68.2%. Okay, so what does this tell us? Now we can say that there's about a 2/3 probability in any given year that the return of the S&P 500 is going to be between about minus 17% and 33%. So that's a really helpful thing to know. So let's see if we can do another one. What's our probability that our return is going to be 1 standard deviation below the mean or less? Okay, so let's start this time with the probability. Okay, so I have 1 standard deviation below or less. So all I have to do here is add up all of these probabilities until I get to 1 standard deviation below the mean. So that'll be 0.1 plus 0.5 plus 1.7. So that's going to be equal to 0.1% plus 0.5% plus 1.7% plus, now I need to look back, 0.1, 0.5, 1.7, 4.4, and 9.2. Okay, so 4.4 plus 9.2%, and if you work that out, you should get 11.5%. Okay, so what's our associated range of SPY returns? Well, we already got the edge here for sigma minus 1 standard deviation. That turned out to be minus 17%. So the range is going to go, in theory, from minus infinity to 1 standard deviation below the mean, and that's going to be minus infin to minus 17%. Okay. So that's our range, and graphically that covers this whole downside tail. So how do we want to describe this in words? This is extremely helpful and important. We want to say something like this. We want to say that there is an 11.5% probability that our annual SPY return will be minus 17% or less. So this is a very helpful thing in terms of risk. And we're going to start looking at these left tail kind of statements more and more. Okay, and this is a good time to bring up some problems with this model. Okay, one, some of you I'm sure have already noticed. Okay, so one is the returns can only go to minus 100%. Normal goes out to minus infinity. Okay, so that's not great, but the amount of the tail below 100% out here is very, very small, so we just deal with that modeling error. Okay, and the second thing is that, remember our foundational assumption? We assumed future returns will look like past returns. And that's not necessarily so. That's maybe a reasonable assumption for something like all the stocks in the S&P 500. But if we're looking at an individual company in particular, that's definitely not true. If we look at Apple, for example, it was growing by 200% a year 12, 15 years ago. Now it's growing by maybe 50% a year, has a completely different product line, completely different set of risks. So the more specific we get here by looking at individual companies in particular, the worse this assumption, future will look like the past, becomes. Okay, so a real good example showing how future returns may not look like the past comes from this article that I've put in readings for us. And this guy who's writing this article is explaining his form of investing that doesn't so much assume a future will look like the past kind of model. It's an interesting article overall, but what I want to bring your attention to in particular is the average lifespan of an S&P 500 company. And you could see back in the good old days, the average lifespan of an S&P 500 company was 55 years, and it's down now to less than 20 years. So what that means, it may still be not mean too much for the S&P 500 because the 500 companies rolling in and out don't affect the index too much overall. But if we're looking at one company, the fact that its lifespan now is less than 20 years means that using a historical future looks like the past model is clearly not going to work, because we want to have, as we know from basic statistics, we want to look back, we want to have a data set of returns of at least about 30 years, right? So if the companies are only lasting 20 years, clearly our future looks like the past model is not going to work well because our data set isn't big enough to make it work well. Okay, enough on that.